Good morning, everybody. I'm Tom Bracken. I'm the president and CEO of the New Jersey Chamber of Commerce. I want to welcome you to the third in our series of webinars co-hosted by ourselves and NJM Insurance Group that we're doing in 2022. We're always looking for key issues that are impacting the small business and the business community post-pandemic, and we've done that in our prior seminars, our prior webinars. And there's been no shortage of challenges to address this year, that is for sure. But over the summer, we did a survey to find out what the biggest challenges were from the business community. At that time, inflation was number one, followed by the labor shortage and supply chain issues. However, also in that survey, 2/3 of the people who were surveyed thought that we were already in a recession, and most of them, the vast majority of them, thought that that would last between 18 and 24 months. So be interesting to hear what Curtis has to say about that. Today's topic is particularly relevant about the economy because it is changing by the day, and there's a lot of dynamics involved. I had the pleasure of hearing Curtis give a presentation earlier this week, and he'll give you a lot of information to think about and process. Anyway, we will have Curtis speak later. He'll be introduced in a minute. If you have any questions during the webinar, please put them into the chat box. We'll try to get to as many of them as we can before we end the session at the 1 hour level. But right now, it is my pleasure to introduce Kevin McMillan, who is the Manager of Commercial Lines Policy Services for NJM Insurance. NJM Insurance Group has been a great partner of ours in this webinar series, a great corporate citizen in the state of New Jersey, and we've enjoyed our partnership and our affiliation with them for many, many years. So, Kevin, it's all yours.
Thank you, Tom. Well, good morning, everybody. As Tom said, my name is Kevin McMillan. I'm the Manager of Commercial Lines Sales and Policyholder Services, excuse me, here at NJM Insurance Group. NJM is a proud sponsor of the webinar series spotlighting the issues facing small businesses in New Jersey. And I want to thank the Chamber of Commerce for the opportunity to briefly speak with you this morning. As we're all aware, the Chamber of Commerce is an essential voice for all New Jersey businesses and have been a vocal advocate down in the corridors in the Capitol building of Trenton. For 109 years, NJM Insurance Group has been helping small businesses with their insurance needs. We've been the largest writer of workers' compensation insurance in New Jersey for more than 70 years. We're also a leading writer of commercial automobile insurance. For over a century, we wrote only these two products, commercial auto and workers' comp. And to meet our customers' expanding business needs as they grew into different states, NJM wanted to accommodate our customers much more, with them expanding into these different states and needing different business products. So in 2018, NJM responsibly expanded our footprint to include New York, Delaware, Maryland, Pennsylvania, and Connecticut. And along with this expansion of our footprint, we also included new products, which include our NJM Pro Edge business policy, which is a business owner's policy providing general liability and property insurance for our small businesses. And for our middle-sized businesses, we launched a NJM Pro Pack CPP, or what's called a commercial package policy, again providing property and liability coverage for our middle-sized businesses. NJM's focus has been on safety and has been a hallmark of our business with respect to providing customer service and identifying injuries when and where they happen, taking care of claims and processing these claims for our customers. We take pride in aligning the right coverages for our policyholder providing outstanding customer service, and sharing profits in the forms of dividends returned to our customers. We want to help our policyholders grow and in turn grow with them. If you're not already an NJM customer, I urge you to visit www.njm.com and to review our products online or our agent directory online. If anyone else has any questions on this webinar, feel free to hit me up in the chat room. I'd be glad to answer any questions for you. So without further ado, I'd like to introduce today's guest speaker, Curtis Dubay. Today's speaker is great interest to all of us. Curtis is the gentleman who follows the U.S. economy's ebbs and flows and predicts where it is likely headed. As the senior economist in the Economic Policy Division at the U.S. Chamber of Commerce, Mr. Dubay tracks the country's economic condition and analyzes public policy's impact on the economy. Curtis also runs the Chief Economists Committee, comprised of chief economists from the U.S. Chamber's member businesses. This committee helps the Chamber formulate economic policies, and it provides analysis to policymakers in Washington, D.C. Before joining the U.S. Chamber, Curtis held positions with the American Bankers Association and PricewaterhouseCoopers, better known as PwC. He is quoted frequently in major newspapers and is seen on CNBC, Fox Business, Fox News, and C-SPAN, and has testified before Congress several times. Curtis earned his master's degree in economics from the University of Connecticut and his bachelor's degree in economics and leadership studies from the University of Richmond. Curtis lives in Washington, D.C. with his wife and 3 sons. It is my great pleasure to introduce to you Curtis Dubay. Curtis?
Good morning. It's good to be with you all. So we're going to talk a lot about what's going on in the economy. But before we get into that, I think it's worth giving you a preview of what's to come. The 2 themes that I'm talking most about these days are we're getting for a period of volatility. The economy is going to have good days, bad days, good months, bad months, good quarters, bad quarters, until we're fully past inflation. And the bad news is that's not going to be until the end of 2024. So we're in for a couple more years of high inflation and economic volatility because the Fed's really going to have to put the screws to the economy to get inflation down. But the silver lining of all that is we are in a very unique economic moment. The economy is certainly slowing. Inflation is a major problem. And higher interest rates are reducing demand. But while all that's going on, people are spending, businesses are hiring, raising wages, and they're investing. That doesn't usually happen during an economic slowdown, and it certainly doesn't usually happen leading up to a recession or during a recession. So we kind of have to recalibrate what we usually expect happens during a period like this to this unique period coming out of COVID and the unique economic circumstances that have resulted. So I'll walk through where the economy is now, talk about recession, talk about inflation, Fed, monetary policy, interest rates, and then I'll talk about other risks to the economy other than all those that you're well aware of. And there will be plenty of time for Q&A at the end. Please keep in mind, I will share slides as we go forward here. You are welcome to the slide deck. You are welcome to use it. I will send it to Ray. He might already have it, and you can use it for your purposes. You can send it around. All the slides are annotated with notes on all the different data points. So please use it as you see fit. Where we are right now is the economy is growing about, we'll call it about 2%. That's fairly good, all things considered. Are you seeing the presentation version? Okay, good.
Yes.
All things considered, all the headwinds that we're facing, the economy's in fairly good condition. Let me get to the slide. There we go. Okay. So about 2% growth this quarter, maybe a little under 2% growth in the fourth quarter. So we could end 2022 growing around 2%. That, again, we've had a pretty rough year. There's a lot of stuff going on. So I'll take that. But of course, you see that the first half of the year with the 2 consecutive quarters of negative economic growth. That is the definition of a recession. But we have this ongoing debate about whether what we had in the first half of the year was a recession. Now, you notice I'm using the past tense, and that is because we're going to grow in the third quarter. We're going to get that data, not next week, but the week after. So 2 weeks from today, actually, 2 weeks from the last Thursday of the month, we'll get data on what the economy did in the third quarter. It's very, very likely to be positive. It's very likely to be pretty strongly positive, again, around 2%. That means that if we had a recession in the first half of the year, it's over. So what that tells me is that the debate about whether we actually had a recession it's highly academic. It's counting how many angels can dance on the head of a pin. It doesn't do much. It doesn't change anything if we declare what we went through in the first half of the year a recession. The reason why we even have this debate is because of the uniqueness of the economic situation. There are other factors that those who decide whether we had a recession use to determine that. And those things are things like job creation, spending, income, manufacturing output. And every other time we've had 2 consecutive quarters of negative economic growth, especially 2 as fairly large as the first 2 quarters of the year, all those things are declining. So it wasn't a hard call. This is different. This is all those things. Job creation was really strong. It has been really strong all year. Income was growing, spending was growing, manufacturing output was growing, or at the very least, holding steady with inflation. So it's not a straightforward call about whether we had a recession. Again, back to the uniqueness of the economic moment that we're in. So I don't think it really matters. I don't think if it doesn't make anything better or worse if we call that part a recession. It doesn't change the future. What does matter is that consumers feel like we were in a recession, are in a recession, and will be in a recession for the foreseeable future. Consumers feel as bad about the economy as they ever have. So their sentiment is way lower than it was you can see in the chart. Look where they were in March and April of 2020. March and April of 2020, keep in mind what's going on there. Locked in your house, out of work maybe, no idea what this virus is going to do to you and the world and your family. And we all felt better about the economy then than we do now, which is just kind of crazy to think about. It's lower than it was during the Great Recession. So when we had really high unemployment, when we had investment banks failing, sovereign debt crises, all these things happening day after day, week after week, consumer confidence never got below this level. And so consumers feel really bad about the economy. And that's been the case since the summer. This is inflation driven, but it's more than just inflation driven. If you drill down inflation is really taking a bite out of families' budgets because it's hitting necessities really hard. This is a chart of it's monthly, but how much each month on an annual basis, food prices are going up. Last month, it was 13% compared to the year before. So if you imagine a family, we've got 3 boys at home that are all under 11. We went grocery shopping. My wife went grocery shopping a couple of weeks ago on a Saturday. $325 wasn't that much food. We ran out by Thursday. And so families are doing this all across the country, week in and week out, multiple times a week. That's going to really add up. And then you throw on top of that gas prices, which are still significantly elevated. They had risen 3 weeks in a row until this week, and now they've come down a little bit, but just a tad. Now they're down from where they were in the early part of the summer when we went over $5 a gallon, but $3.87 a gallon is still pretty high. And when you add that to the higher food prices, you can see how that's going to squeeze family budgets and put them in a sour mood on the economy. So to talk, and by the way, housing is up significantly as well. Housing, of course, as we all know, the prices really took off during the pandemic. And it takes a while for that data to filter through into the CPI calculation or to the inflation calculation. It's now doing that, and it's putting upward pressure on the data. So anyway, so food, shelter, energy are all going up. So of course, consumers are going to feel bad. That's all a way. This is the statistical way to show it. Real wages are declining. So wage growth has been strong. You all run businesses. You know that you're paying your workers a heck of a lot more than you were paying them a year ago or 2 years ago. Wage growth is still over 5% on an annual basis. That's really strong. But if inflation's 8.5%, you're losing 3% a month on an annual basis, and people recognize that, and so they're going to reflect that in their sentiment. Now, the key thing to remember when we talk about consumer sentiment, and this applies to businesses as well, business sentiment. When you look at all sorts of surveys, when you look at the survey for small businesses, we have a survey for small businesses. The National Foundation of Independent Businesses has a small business survey. Feeling bad. The ISM surveys for manufacturers and service providers, that's really low. They feel very badly about the economy. But consumers and businesses alike are not acting like they feel bad about the economy. Again, back to that silver lining. So when it comes to consumers, they're spending. Retail sales were fairly good in September. We don't have full consumption. Retail sales is just sales at physical stores and online and at bars and restaurants, so it doesn't include services. And it doesn't really capture business spending. But the consumption number will come out 2 weeks from tomorrow. That will include all spending in the economy. But back in August, it rose. So consumers continue to spend, even in the face of inflation, even though they're feeling bad. That's not normal. Usually when they're feeling bad about the economy, they're going to pull back and not do that spending. Now they're able to keep spending because the job market remains strong. If you want a job, you can have it. Wage growth remains strong, and they have a whole lot of savings still built up that they can tap into that they accumulated during the pandemic. Businesses, it's a similar story. They feel badly about the economy, but they are continuing to hire. Hiring remains really strong. They are continuing to raise wages. Clearly, we're seeing wage increases. So they're hiring and paying higher wages, and they continue to plan to invest in capital and capital investments next year and going forward. I think it was 86% in one of the CEO surveys said that they continue to keep on with their investment plans. Again, not the actions you would anticipate for a business that is going into a recession. Usually that's when you pull back on expenses, you try to reinforce everything, make sure that you are prepared to weather the storm. So we're calling this secondhand pessimism. That's what's being picked up in the surveys. So businesses themselves and consumers themselves feel strongly about their personal situations, but they're telling surveyors that they feel badly because they're picking up all the bad vibes around the economy. Now, that's not to say things are good or better than we're going to talk about. It just means that when the economy slows further, it's going to slow further, that maybe the downside isn't as steep as we think it is because consumers and businesses are in a fairly strong situation. Okay, so with that, it's time to go on to the big issue in the economy that will be the big issue for 2 years, and that's inflation. So inflation is now at a little over 8%. It is it's been really high for a long time now. It crossed the Fed's 2% target, crossed that threshold back in March of 2021, and has stayed well above it since then. Inflation can be volatile, but core inflation, when you take out food, energy, and other volatile aspects, it's at a 40-year high. That's a really bad sign to the Fed. It's a signal that they need to keep tightening, and that inflation is not in hand yet. Now, I'm not gonna call it a peak, but it does seem like we're unlikely to get back to 9.1% on an annual basis. That it will start to come down as we go forward, but we're still really high, and it's going to take a while for it to get down. It's been 40 years since we've had inflation, so I do think it's worthwhile to touch on really briefly why inflation is bad and why the Fed is going to be so focused on bringing it down as much and as fast as it can. So I went through the family side, the budgets being squeezed, but inflation is also a pernicious factor because it makes planning almost impossible. So you're all business owners running businesses. You know this, that when you don't know what the price of your inputs are going to be, when you don't know what the price of your labor is going to be, then it makes it really hard to plan going forward. And it really isn't more complicated than that. When there's so much uncertainty, businesses are likely to pull back and pull off, and that will have a big negative effect on the economy. And of course, financing, it gets a lot more difficult in higher inflation environments. Nobody wants to lend, and it becomes a major weight on the economy. So that's why the Fed's going to be really, really focused on it. I do also think we should run through quickly where inflation came from. So what I've been saying is that there are two different causes. One is COVID and everything that happened from that. That was, remember back a year ago, people were talking about inflation being temporary or transitory. Well, there were temporary transitory causes of inflation. Those things were market-based. We had major issues in the supply chain because of COVID. Then we had a shift in demand from services to goods that further put stress on the supply chain. Then we had an increase in demand because of all the fiscal support, multiple rounds of checks, unemployment insurance, or extra unemployment insurance from the federal government, really big child tax credit payments, all that money being pushed out in the economy, increased demand, further stress on the supply chain, and prices are rising because of the demand, because of the shift in demand, because it's really hard to get anything. Then you had worker shortages, which put upward pressure on prices. Worker crises put upward pressure on wages, which got passed into prices, and you got this really big COVID-driven increase in prices that is directly tied to supply and demand. Really, really high demand, really constrained supply. Of course, prices are going to rise. The best example of this is the auto industry. We had at least demand staying where it was, if not rising, for autos, but they couldn't roll those cars off the assembly lines because they couldn't get the parts necessary to finish them, electronics, other things. And the price of new cars went skyrocketing because demand was high and supply was constrained. And that spilled over to increases in used car prices, and that still remains the case today. Now, of course, that will work itself out. There's not a policy reason for that other than, unless you want to talk about supply chain, but that's a market-based one. There's lots of examples like that that we can run through, but that's a one that I think a lot of people understand. Those things will work themselves out over time, especially as we shift back to services and take some pressure off the supply chain, work itself out. If it wasn't for those factors, though, that's probably 2 percentage points. So you're looking at inflation still being over 6%, and that's still well above the Fed's target. And the rest of it comes from monetary policy, from the vast increase of the money supply. This is the old Milton Friedman dictum. He won a Nobel Prize for basically this statement, which is that inflation is everywhere and always a monetary phenomenon. So it comes from increases in the money supply. And we had an enormous increase in the money supply. Starting in February of 2020 through earlier this year, the money supply increased, this is nominal, so not inflation adjusted, but $8 trillion of money put into the system by the Federal Reserve. That's not including the fiscal stuff that happens from Congress. This is just creation of money. Not to criticize the Fed, but because they had to do this. This was the reaction to COVID. This was making sure we didn't have a financial crisis while we're going through a pandemic. And it worked. We didn't have any of that. This was successful. The problem is the timing got away from the Fed. Ideally, what would have happened is that the economy, we've gotten past COVID, the economy would have recovered, they can withdraw the support and not have runaway inflation. A couple of things happened. One is that the economy recovered faster than anyone thought it was going to recover, including the Fed. So that in March of 2021, the economy was doing really well. There had been already a lot of fiscal support, so a lot of people had a lot of money to spend. And then just sheer coincidence, March 2021, another $2 trillion gets thrown on the already kind of raging fire with the American Rescue Plan, which was just a whole lot of checks to a lot of different constituencies, and away things took off. Fed was slow to react. They didn't really change the stance of monetary policy. They didn't change monetary policy, the actual implementation of it, until March of this year. They only indicated they were going to start changing in November of last year. So it hasn't even been a year that they were going to move into an anti-inflationary stance. There's a reason for that as well, though. Remember back in March of 21 that we were not past COVID yet. We still didn't have vaccines widely administered. We still had not gone through, or we're still on the horizon. We're still the Delta wave and the Omicron wave. We can go back and look at charts from that period and show virus is up, economic activity down. And so they could not fully move away from the support because and those were major waves and major problems. If we had another, but if it had a bigger impact on the economy, they would have needed to keep the support in place. So the time didn't work out. We get a huge increase in the money supply and we get a huge increase in inflation a couple years later. Notice there's a lag there. February of 2020 is when the money supply really starts taking off. It keeps growing, but the impact on prices doesn't really come until a year plus later. That's where I get the analysis that it took a year and a half, 2 years for inflation to really take off. It's going to take just as long for it to come down. And that's because there are lags when it comes to monetary policy. So that's where the crux of the inflation comes. That's so if we're 6 percentage points above inflation, 2/3 of it's are above the 2% target. 2/3 of it's coming from the Fed. 1/3 of it's coming from the COVID issues, the temporary issues. That's changing though. Those temporary issues will lessen over time, and now it's mostly a monetary phenomenon. So it does come down to the Fed to bring inflation back down. So what they're going to do that is if you notice real quick, let's go back. This money supply is steady. It's not coming down. This is nominal terms, but it's not coming down, but it's just not growing. And that's enough. What we need time. So what this comes down to, I talked a little bit about demand going high and supply being constrained for the real impacts. Similar thing here. And so what you have is too many dollars chasing too few goods. It applies to the real economy, but it applies to the financial side as well. A lot of dollars chasing this limited supply of goods and services. We got to allow the economy to catch up to the size of the money supply. At least holding the size of the money supply constant will allow that to occur. So it doesn't have to shrink so much, but it has to stop growing, and it finally has done that. And that mostly comes from asset purchases, from what they do with the balance sheet. They're not buying anymore. They're not reinvesting proceeds. They're allowing that to roll off, and that will help shrink the supply of money. As will higher interest rates. Higher interest rates will lead to less credit creation, and we're seeing that already. So the Fed is raising market interest rates. We started in March at 0% federal funds rate. We're now up to 3.25 or 3.25. So 3 percentage point increase in the federal funds rate has led to much higher market rates. We started the year at the 30-year average fixed rate mortgage at 3%. It is now, I think it's at 7%. I haven't updated it this week. I will do that soon, but we're getting near, if we're not already at 7% on the 30-year fixed rate mortgage. Of course, that's going to lead to less demand in the housing market. We're already seeing this. The housing market is cooling significantly from where it was. Makes sense. It's a heck of a lot more expensive to borrow and to buy a house. The first impact is going to be on demand. The next thing that will happen is there'll be a negotiation between home sellers and home buyers. The home sellers are going to eat some of that higher interest rate at some point, but the initial move is for potential buyers to pull back and say, we're not going to buy right now because interest rates are 7%. Think about the lock-in effect that you have. People who bought homes, say from the Great Recession, the financial crisis on until earlier part of this year, don't want to flip their 3% mortgage for a 7.5% mortgage. That means there has to be some price pressure coming down, and that hasn't popped up yet, but it will be. It's only pulling a little bit. We had over 20% annual increases month after month when it came to home prices. It's down to 15% as of, I think that data lags. It's either July or August, but I think it's July. It's going to come down more. I don't think we're in any housing bubble, or we're going to see probably won't even see negative price declines on the housing market, but we're not going to see 20% annual increases anymore either. So you can see how it works in the housing market, but this is going to apply to any interest sensitive good or service that people buy. So the price will go up to buy it, and that will bring down demand. This is going to apply to housing, home repairs, home improvements, cars, electronics, home appliances. boats, RVs, trailers, expensive vacations, anything that you can think of that consumers use credit to buy is now going to be more expensive, and they're going to buy less of it. Pretty straightforward. Less demand will put downward pressure on prices, or there won't be so much upward pressure on prices, and you'll see some easing on prices. And then that will seep out to other areas of the economy. Let's use housing. Let's stick with housing as a good example of this. So imagine, let's do new home building. Home starts declined yesterday pretty substantially in September. We've seen home starts fall pretty rapidly. So think about all the things that go into building a home, and then they're not necessarily interest sensitive, but they're clearly tied to a product that is. And that applies the same. You can do the same analysis for autos as well. Lots of different things, but home. So lumber demand is going to go down. Prices are going to go down. Lumber has been fluctuating greatly, but when there's less home building, there's going to be less demand for lumber. The price will come down there. There will be less demand for steel, less demand for appliances, less demand for all the things that go into a home. And then in those sectors, in those industries, demand will come down. Price pressures will abate. Again, you can do that for cars, you do that for all sorts of things. That's how it spreads out over the economy, and that's how we get a reducing of price pressures. Same thing's going to apply on the business side. The average the average AAA rated corporate bond is now over 4.5%, I think. It started the year just over 2%. Borrowing for businesses is going to be more expensive. That means they're going to do less of it. They're going to do less investing. So not building a new warehouse, not building a new factory, that impacts demand as well. And again, lessening of price pressures. So what does that mean for the economy going forward? And I'll wrap up here and then we'll go to Q&A. We are going to, again, I talked about this volatile, but we're in for a slow growth economy at best for the next couple of years. I would say it's a 50-50 chance of having a recession in 2023 and a 50-50 chance of having one in 2024 if we don't have one in 2023. So a good chance we're going to have a recession over the next couple of years. Now, it could prove to be mild. I don't think it's going to last more than 6 months. Especially about those unique factors I talked about could keep us from having a really, really steep drop off. Businesses don't want to lay off right now. You've all learned how hard it is to make your good, provide your service without the necessary workers. So maybe businesses hold on to workers, and so incomes remain steady, spending can remain on pace with inflation. So maybe we don't have a big pullback there. There's a lot of job openings. Maybe the pressure goes there instead of layoffs. So that's a potential silver lining that keeps us from having a very steep recession. So again, put that like 50% to have and the recession comes from the cooling of demand because of those higher interest rates and the seeping out. The other scenario, so that's okay. There's 3 scenarios. One is we don't have a recession, we just have slow growth because as we get through inflation through 2024 until we're finally beyond, inflation comes down steadily to close to 2%. By the way, we may never get to 2%. We might just declare a new higher target, 3%, whatever it is, and move forward. But it takes a while, goes slow growth in the late 2024. 50% chance, that's probably a little optimistic. The next scenario is a recession in either 2023 or 2024 that is necessary to get inflation down, and it comes down after, and then we go forward. And then the worst scenario is a double dip recession. That is a recession in the middle part of 2023, so Q2, Q3. We come out of it in late 2023 and go into 2024, and inflation still isn't coming down sharp enough. The Fed has to keep raising in a weak economy, and we have a second recession, which would be steeper, still short, but steeper than the first one. Still though, inflation comes down after, and we go forward into 2025. 2025, we're in good shape. Past inflation, and then the economy should be in a much stronger position, because usually when you have a huge economic event like we just had, you have other things bubbling up. So we have a COVID recession, we have a bumpy recovery, and something happens, and we find out that there's weakness in the economy that didn't happen this time. We didn't have those spillovers. It tells me that the economy was very good position, and is in good position to take off once we get past inflation. The The other strong case for at least and by the way, so the double dip scenario comes out of history. The last time we had inflation was in 1981 or the 70s into the early 80s. We had to get inflation down. We had, I think, a recession in 80, 81, and then one in 80, 81, 82. The second one was very severe. So that's where analysts get this pattern from what the last time the Fed had to really ramp up interest rates to get inflation down. Now, the same pattern could play itself out. There's no doubt about that. But there's some really key material differences between the early 80s and today. And so the history lesson really is illuminating and necessary to go through. The biggest difference is that inflation was ingrained in the economy, in the minds of all of us, in the American psyche in the early 80s. It had been in place since the 70s. It's been about a decade of high inflation. So we expected inflation to be high. And when inflation expectations are high, it's really hard to root out inflation. It's just a much harder slog. So if we had done this chart back then, you'd see inflation 7-8% in the long term. This is a financial market expectation, long-term inflation right near the Fed's target. So we do see this as coming down in the near future. That should make the Fed's job easier. There's a lot of psychology that goes into inflation. That's probably not the best footing for economists to be on. We're not psychologists, not people, but there's a lot of psychology that we don't necessarily understand. But we do know that when that expectation is ingrained in people's minds, it's harder. That it's not ingrained, it is anchored, means that the Fed's job should be easier. Now, if you recall, the Fed funds rate, Reagan comes in, gives Volcker the mandate to bring out inflation, and Volcker does so in a rather ruthless way. Fed funds rate goes to 22% in 1981-82. That is a painful time to borrow, no doubt about it. But it had three impacts. It had one, it got inflation down. Let's start with one. It caused a very severe recession in 81-82, very steep. But two follow-on effects were it worked. Inflation came down and remained down for the next 40 years. We didn't see high inflation again until March of 2021. And then we had a period of very, very robust economic growth from early 82, middle of the late 82 until the S&L crisis later in the 80s. So those are the three outcomes. Again, I think that it really does matter that we are in a much different scenario now. So I don't think we'll have as nearly as severe a recession. The Fed thinks we'll top out at a Fed funds rate of 4.6%, far cry from 22%. I think they're probably a little dovish on that part. I think we'll probably have to go a little higher, but it's not where we were in 81, 82. So hopefully that we can get inflation down without as much disruption and do it in a shorter way, and then we can get on to those smoother times in the future. So let me just close real quick with a few other risks. So a lot of things are built into what I just talked about. These are things that are not built in. These are things that could happen that would change everything that I've just said. We could have a really hard landing. We could have a really hard, steep recession in 2023. It certainly could happen. There are some well-known economists that are saying the Fed is acting too aggressively now. I just don't buy into that. Again, the Fed funds rate is 3%. How is that being too difficult? It wasn't that long ago that a 7% 30-year fixed rate mortgage would have been kind of normal, or 4.5% AAA rated corporate bond was fairly low. We're not in unprecedented territory. It hasn't been this way in 15 years. But I just don't see the Fed as being overly aggressive yet. To me, it's the other way. They haven't been aggressive enough. But I could be wrong. We could have a pretty severe recession next year. That would come also. We could also have longer inflation than through 2024. Chair Powell said a couple weeks ago that turns out we know less about inflation than we thought we did, which is back to that economists aren't people. It's like inflation is a lot of psychology involved in it. Maybe we don't understand it as well. There's a lot of changes in the financial system that are hard to understand. A lot of changes since the last major bout of inflation. A lot of changes in the last couple of years when it comes to fintech and all the way that credit is disintermediated through the economy. Totally new world. Maybe we don't know as much about inflation and we don't money creation and credit as we thought we did, and it's going to be harder to wring out than we anticipated. Something else arises in the economy. These are always the unknown unknowns that are out there. So a financial crisis, a pandemic, a dot-com bubble bursting, an S&L crisis, a further oil shock, things like that. These things can always happen. There's always a chance that they will occur. Geopolitical turmoil. The Russia-Ukraine war spills out and gets worse. And then the energy implications get even worse for Europe. They're going to have a bad winter until they can figure out how to get natural gas and other energy sources into the country. It could be a bumpy couple of years for them. But that could spill out and get even worse. China could invade Taiwan. You could have another geopolitical event pop up that is not on our radar right now. And then lastly, political risk here in the US. It comes from, doesn't matter which party wins in November, there's substantial risk. If the Democrats win, they're going to keep spending. That $5 to $6 trillion spending bill that they didn't get through this year will come right back and go right back into the legislative process in January. So that will put more pressure on inflation. And there will be a heck of a lot more new taxes on businesses in that. And there will be a lot more regulation on businesses as well. And then if the Republicans win, the threat is that they're just not going to want to pass any kind of spending bill. So we could have situations where we have long periods of government shutdowns because they won't pass a budget, they won't pass a debt limit increase, and that has a tangible impact on the economy. Okay, I've been talking for a while, I've said a lot. Key takeaways are bumpy ride for the next couple of years, smooth sailing in 2025. We may never get down to 2% inflation, but it will come down at some point as the Fed's policies do take effect. So I'll stop there. Happy to answer questions on anything I talked about or anything I didn't get to.
Okay, Curtis, thanks. Yeah, you gave us a lot to digest there. So let me break a few things down relative to the audience we have here. So we have a lot of business people on this call who are all trying to plan their next year, their next few quarters or whatever. So one of the things I heard you say early on was that it's a very unique economic situation that we're in. So if the Fed is trying to remediate inflation by raising the interest rates, but consumer spending remains high, doesn't the one negate the other in terms of trying to fight inflation?
To some extent, yes, except that there's still going to be an overall reduction. Well, so demand can stay high. It's a good question. It's making me think it through. I haven't answered it before. Demand can remain where it is, but demand won't be increasing. So again, a lot of what we need isn't that prices have to come down. I mean, you're all business operators and owners, right? You're probably not going to lower your prices, but if you're not having to raise them on a daily, weekly, monthly basis, that has a strongly positive impact on the inflation number. So you can have demand remain steady and prices not rising anymore, and that will take a huge amount of pressure out.
Okay, so if I'm planning a business for the next year, you're saying probably should look at the potential or good potential of a recession of one kind or another, if not in 2023, 2024. I think it'll be a fairly mild recession relative to past ones.
Yeah, well, it's clearly not a COVID recession, not 33%, excuse me, decline in economic activity, and not on the par of the Great Recession, which is very, very steep drop off. And that lasted for 2 years. Was it January? I forget when it started in 07, but it ended in June of 2009. So it was a couple of years, nowhere near that length and not that depth. And again, back to that theme of uniqueness, we could have a situation where we have a recession. It could even be minus 2 or 3 percentage points off GDP, but we don't lose jobs because of the underlying strength of the labor market, the tightness of it, but that there's just businesses don't want to lose workers right now, and so you could have this really strange situation where the economy is contracting, but we're adding workers, or we're not losing them.
And you didn't touch too much on this during the presentation, but talking about the labor market. So most of our members, and I think a lot of businesses, certainly in the state but around the country, would say that labor is still an issue. Finding workers is still very difficult. So how does that play into this?
Yeah, it's still a major issue. Let me see if I can share my screen again. And this is part of the deck, and again, it's available to all of you. You can see that we still have over 10 million job openings and only about 6 million unemployed workers to fill them. So the gap between them is 4 million. So 4 million more job openings than we have workers to fill them. That's going to mean a very tight labor market remaining. It's not only that, quits remain really high. So people are still quitting and leaving their job. It tells me that they're very confident that they can get another job. We're never going to have a situation. We're always going to have a lot of job openings because the skills gap, the available workers don't have the skills that employers are looking for. That existed pre-COVID. It's going to exist post-COVID. But right now, we still have a major issue with this COVID gap here. Lingering COVID gap, I think, is probably the time to say it. I don't have a good answer for why this is persisting, other than I think there are. So I used to talk a lot about COVID because of keeping people out of work, being sick. Quarantines were difficult. You're working and working somebody who had it, and now you have to leave. You can't come to work. You're sick with COVID. You're caring for someone sick with COVID. You have long COVID. You're carrying someone with long COVID. Those things are lessening. But I do think the one COVID thing that is lingering is childcare. I don't think the daycares are fully functional. They have a worker shortage, so they can't take in all the kids that they otherwise would. They have really, from what I hear, my kids are not daycare age anymore, but everything I hear is that they still have really strong quarantine rules. So if your kid comes in and sniffs twice, he's out. Like I've been there with like, hey, your kid threw up, and I'm like, it's fine. He's just leave it. He's gonna be fine. You're not, and they still send you home. But now they send you home with a sniffle or a cough. And then, so that makes it really hard for at least one parent to rejoin the workforce if the kid can't get a spot or it's constantly sent home. And that's falling more heavily on women. It's still the nature of the labor market that women are the primary caregivers. So they're not returning to the labor market as quickly. But then you still have a huge savings glut that people are spending down. Every bar above the dotted line is in excess of the pre-COVID average. That adds up to a lot of money. It was almost $3 trillion in excess savings at one point. Now it's coming down some as people are there's more stuff to spend on. They're not getting the fiscal support. They had to spend on necessities. Remember, we had a rent and mortgage moratorium. You'd have to pay for your house if you didn't want to for almost 2 years. So that it is coming down, but it's still about $2.5 trillion in excess savings. There's a lot of savings. So people are spending that down instead of returning to work. And then the last is permanent, or not permanent, but lifestyle changes that have kept people out of the labor force. Early retirees, people reskilling, being in an industry they didn't really like pre-COVID, and now gaining new skills, shifting over a new industry, and hopefully soon taking a job in another industry. There are people who figured out they could make ends meet with one person in the labor market, and so one person has left and spending more time at home. And then part of that is those of us who got to watch Zoom school for a year and a half over our kids' shoulders and decided that this wasn't going to work. We didn't do this, but I could totally understand why people would determine that, and again, have left the labor market to do homeschooling or spend more time at home. I have no idea what proportion of the gap each of those things represent. I think it gets close to the 4 million. We're about 3 million missing workers from the labor force as well. There could be other factors. I could be missing something. I haven't seen a good explanation yet.
Okay, then to go back to inflation then for a moment. So we're going to be looking at inflation for something close to the next 2 years, an inflationary economy for something close to the next 2 years. What are the numbers? What are the facets we should be looking at that will indicate to us that inflation surely is coming down and is going to stay down? What are some of the numbers or measures or key indicators for that?
That's an interesting question. Other than the monthly report of the data, that's a hard one, because I think people will ascribe anecdotal evidence to either way that they want it to go. So if you're really committed to seeing, and just the way the world works now, it's people see the world through a political lens. So if you're really committed to inflation coming down in advance of 2024, you're going to go to the grocery store and say, hey, the price of bacon came down below $8 a pound. So things must be going well. But then if you're really committed to seeing it stay high, so one side pays a political price, you're going to go and say, yeah, but my cereal is $6 a box now. So you're going to pick out those anecdotes that confirm your prior preference. So I think you really just have to wait and see, and that always happens. There's always fluctuations in specific prices. Some prices go up, some prices go down. Inflation is all prices broadly rising. Now that can be lumpy in periods, but in general, it's a general increase in the price level. So I think you do have to kind of wait and see the overall data, because that does, whether you ascribe to whether CPI is calculated correctly, or that's not really relevant. What's relevant is the trend, and you can't really pick that up until you see the overall, because you could be in let's see, you could be, the West Coast has more fluctuations on energy prices. Okay, let's use the Northeast. I'm from Connecticut, and energy prices are gonna be high this winter. And you could be there and say, oh my gosh, my oil bill is twice what it was last year. Inflation's out of control. But you could be in the Southwest, and it's not really that big of an issue. So regional issues play a factor as well. You really need the national indication. So that, because the things that you see the most part are volatile, energy and food. I guess the one that I will say is housing prices. If you see big markdowns, if you see houses staying on the market longer and then big markdowns, that's a pretty good indication that prices are finally starting to ease.
Okay, and we're running short on time here, but I did want to ask this one macro question. You said at the beginning we're in a unique economic situation in terms of a lot of the measures that you use. So so you said we need to recalibrate about what we think happens in a recession. We need to recalibrate how we define a recession from the classic, was it 2 straight quarters of negative GDP growth?
Well, we don't have to recalibrate it. We just have to say that sometimes the exception proves the rule. I don't think this will ever happen again. I don't think we'll ever have a situation where the economy will drop for 2 consecutive quarters and we won't see jobs contracting, incomes falling, spending falling, and manufacturing output not falling. So those things, I think it's just going to be a unique situation in economic history. If we have something similar happen in the future, it means we had a very unusual event like we had with COVID.
All right. Any last thoughts, Curtis, before we wrap up?
No, I fit a lot.
All right. And I will say that we're going to make, as you said, we're going to make the slides available to everybody, your visuals available to all the registrants afterwards. So everybody can look for an email from us that will include the link to where you can find Curtis information and visual. So Curtis, thanks very much for all this information today. It gives us a lot to think about, and not sure we all know where it's all going, but at least kind of get a roadmap to where it can go. So thank you for that. Thank you everybody for joining us here today. We'll be partnering with NJM on another webinar next month again to talk about how some ways businesses can think about alleviating and addressing their labor shortage. So again, thank you, Curtis.
Sure, anytime.
Thank you, NJM. Thank you, everybody, and we will see you next month. Thank you. Have a good day.